All right, so class 3, if you can go on video, I'd really appreciate it. Help me a lot. I'm still trying to learn names and faces as much as possible. So what we want to do today, just real quick, there's 45 students in this class, and I've heard back from 25 of you, so you're doing better than most classes. So 20 of you still need to send in that schedule so I can get your teams assigned. I like to do that as quickly as possible. So if you haven't sent it in, I won't call out names, but I will. Eventually, I'll have to email you individually, which just takes me more time. So you save me a lot of time if you just get that schedule turned in. I appreciate the ones that have turned it in. That helps a lot. We don't need the groups until the second half, but I do need it to get the Excel applications out, which is going to come up next probably 2 to 3 weeks. So the faster we can get it done, the better. The company selection, I decided to wait till Thursday to go pull the data just because I have another meeting on Thursday, so I can double up on that. You don't really want to start working in your company anyway, probably until this weekend. So what I'll do is those of you that asked for other companies, I've got a few requests out there. I'll pull those other companies in, and I'm going to do a real quick check to see if they have 2021 data yet. I think most of them probably don't. So most of them probably won't change, but a few of them might have 2021 data. So I'll pull that in. Otherwise, the file that's out there is probably pretty good. I've had some questions about some firms. A good example is Netflix. Netflix would work. They have one problem, and their problem is their cash from operations has been really negative. And that messes up some formulas, but I'll show you in class as we get into it, especially next week. There are a few of the formulas where I use cash from operations to divide, but I'll show you if cash from operations is negative and a problem, we can do something else to divide by. We can divide by revenue. So our gross margin, there's other things we can divide by. So I'll show you that in class. So if you have a company who's, if we're dividing by cash from operations to try to show how large a particular item is, but cash from operations is negative, then we get a nonsensical answer. But if we substitute revenue can't be negative, so that fixes that problem. So I'll show you some things you can do, and you just have to make one quick change in the Excel and make one quick change to the title, which just shows you why you're going to want on next Tuesday to have your company loaded in Excel and ready to go. And I'll send a link to a YouTube. It walks you through the entire project one, but all you need to watch on that YouTube is to make sure you know how to get the data into the Excel model. So I'll make sure all that's ready to go this weekend, so you'll be ready to go on Tuesday. If you haven't emailed me with the company I did, then email me. I think I've got all the ones ready to go that y'all sent me. Any questions on any administrative things? All right, so last time we were talking about the essence of finance. I don't want to spend a whole lot of time on that because I do want to get to the accounting review. So this is the key to this class. Everything we do in this class is focused on this process of how do we create value in finance. And as we said, it starts with forecasting. That's number one. You forecast the future. When you do your team project, you'll have to do some forecasting. We'll talk about that. Then you have to do some risk assessment. That's number two. We assess risk by picking a discount rate. For your group project, you're probably just going to pick a generic rate because we won't be far enough in the class for you to do a deep dive into what's the appropriate discount rate for your project. So you'll probably just use 5%. But that's an important concept. But you will get later in the class some practice. I think 3 or 4 actually of the Excel applications involve a discount rate in some way. So you'll get pretty good practice with that because that's a pretty important concept. So that's really the bulk of finance right there. You forecast your cash flows, you assess risk so you can value those cash flows in today's dollars. And then 3, 4, and 5, pretty straightforward. Number 3 is just the sum of those discounted cash flows that says what you think that project's worth. You compare that to what you can buy on the market or what the cost of the project is, and then you make a decision. So that in a nutshell is the whole of finance. And we spend most of our time on number one and number two. So the discount rate you're going to see in this class, a discount rate in finance has two pieces. We have something we call the risk-free rate. I don't really like that term because we're not really sure what's risk-free. Anybody have a guess on what we normally use? What would be a good risk-free rate? Any guesses out there? What's the least risky asset you can think of? If you bought it, you're pretty sure you're going to get your money back and interest.
Land?
Land might be pretty speculative. Depends on where you buy it. You're talking over 100, 200 years, maybe so, but land can be pretty speculative. There may be places where land is so valuable. Let me check the chat here. Okay, AJ said bonds. That's in the ballpark of what I'm talking about. Gold prices can drop just like land. Or a house in Austin. I'm selling my mom's house in Austin right now. I bought it for cash to help her with her retirement, and now she's telling me about all these foundation issues, and I'm trying to sell her house. It's like, oh, thanks, Mom. So that house is plus or minus probably about $75,000. I can't figure out. So AJ, I don't know who AJ is. I don't know what your first name is, but AJ's in the right ballpark. What bond could you buy that you're pretty sure you're getting your money back? There you go, Julia. Yeah, government bonds. And Patrick, you say CD. CD is kind of in that category, right? Because if you buy a CD from a bank, the federal government gives you FDIC insurance, right? So that's almost as safe as a government bond. But the US government is very, very safe because they can print money. And they got the full faith in, they can increase taxes, but they can print money. If you could print money in your basement, you'd be pretty low risk. You could print money and pay all your debts back. You wouldn't have any issues. So the federal government is considered the lowest risk. We're going to talk specifically about which government bond. Do we use a 1-year government bond, a 5-year government bond, a 10-year? We're going to get into that detail there. So we will be using government bonds. If any of y'all ever go out to Yahoo Finance, it's a really good website, Yahoo Finance. There's only one interest rate on Yahoo Finance, and it's the 10-year Treasury yield. The 10-year Treasury yield is the most important interest rate in the world. It prices more securities than any other bonds. So when you see the risk-free rate, one of the most popular risk-free rates out there is the 10-year Treasury yield. We're actually going to use a 10-year Treasury government bond when we price stocks, because it's very, very common. So the risk-free rate is something that you say, I can do this project, but if I didn't do this project, I know for sure I can buy this government bond and I'll get my money back. So if this project doesn't give me at least that, I'll just go buy the government bond, right? A government bonds are paying 2%. And this project has a 1% return. Why would I buy this risky project? I'll just go buy the government bond, make 2%, and I don't have any risk. So the risk-free is like that benchmark that's always there. There's no risk. If you can't get at least that, then just go buy the risk-free asset. Now, I know there's a lot of debate on that. Is the 10-year Treasury really risk-free or not? You can debate that. But right now, we're going to define that as our risk-free. And then we're going to add on top of that an extra return that we need to cover for risk. And there we're going to cover all different types of theories in finance. The most important one that you'll see, which is one you want to remember in future classes, is something called the capital asset pricing model. We'll look at that here a little bit today, but we'll definitely cover that in this class. If you're a finance major, you're going to see it in every single class you take going forward. It's a little bit ridiculous. I took the certified financial analyst exam, probably the hardest exam I took in my entire career. But I came out of part one knowing I had passed it because they just kept asking these capital asset pricing model questions over and over and over again. I was like, okay, I got it. So it's hit pretty hard in finance. So we'll cover that. But that's it, risk-free rate plus a risk premium. So Ashley, you mentioned land. Land would have a different discount rate than, say, a house in Austin versus gold versus, everything's going to have its own discount rate depending on the risk. And we're going to talk that in finance, our view of risk is a little peculiar. The way we assess risk is very different than probably normal people out there do. So we'll get into that in this class. So the risk-free rate is usually the yield on a treasury that's comparable to what you're looking at. So if we're trying to figure out the value of a 5-year corporate bond, money we're loaning to IBM, then we'll probably use the 5-year treasury. So we want to line those up. And you'll see that later in the class. You have some exercises on that. And the risk premium is very, very subjective. It's how much you need over and above the risk-free rate that's going to induce you to buy that asset. All right, so right now, Puerto Rico has been going through some struggles. People talk about, will the US government let them default on their debt? They had that hurricane. They've had some problems. They could default. If Puerto Rican debt was paying 2%, would you loan money to Puerto Rico at 2%? I sure wouldn't. I can get 2% really low risk somewhere else. But what if Puerto Rican debt was paying 24%? The US government might step in and help bail them out. Maybe. They seem to be getting things cleaned up now and getting in better shape. I should show you some charts from the Bloomberg machine that shows you the history of Puerto Rican debt. It's kind of interesting. When Hurricane Maria hit, Puerto Rican debt's risk premiums shot up dramatically. People buying Puerto Rican debt said after Hurricane Maria, we need a much higher risk premium than before because this country has a lot of problems. And then President Trump went to Puerto Rico and he started talking, and guess what happened? The risk premium jumped again. Why? Because President Trump implied that the US government was not going to bail them out. And so their risk premium went from like 5% to 15% to like 30%. So they got Hurricane Maria, then they got Hurricane Trump, because he said the worst thing from their standpoint, he could have said. And if you watch Bloomberg, you'll just see those risk premiums just bouncing all over the place. Right now, you probably would have been good to have bought Puerto Rican debt right after Trump's speech, because the market somewhat overreacted and it's come back down. I should go and get it. I don't follow it that closely. Same thing with other countries. Venezuela is going through something right now. My Spanish teacher, she lives in Peru. Peru is going through some crisis now. Chile, obviously Venezuela. So there's some issues going on in South America. Obviously, there's issues going on in Europe. Italy and some of these countries that are really struggling with really high debt loads. But each country is their own thing. So if you're loaning money to Brazil or to South Africa or to Italy, you're going to have different risk premiums depending on the perception of getting your money back. All right. So risk premium is extremely important in finance. It's probably one of the most important parts of finance. And there's a lot of debate and a lot of theories. We'll get into the most basic theories in this class. If you're a finance major, you're going to have to delve into this a lot more. And if you're an accounting major, you're probably going to hit this as well. Accounting majors do have to hit this. Any questions on that? Very, very important concept. So let me check right now. So right now you can buy a 10-year treasury for about 1.75%. So if you buy a 10-year treasury, you're guaranteed to make 1.75% for 10 years. If I told you the stock market was priced to make a 6% return, you could make 6% investing in stocks, but with a lot of risk, or you can get 1.75% without risk. Would that 6% expected return on stocks be enough to induce you to buy stocks? Or would you need 7%? Or would you need 8%? Or would you need 12%? Or maybe you only need 3%. And what's the answer to that? The answer that's going to vary by person, by person, by person. Each person is going to have their own answer to that. I personally think stocks are priced to make about 7 or 8%, but I do think they're probably going to sell off here some more. So maybe I'll wait a while, not because of my risk premium, but more because of my market timing. I think I can find a better place to come in. So there's a lot of things going on in finance. and hopefully you have a good, strong theoretical basis for whatever you're using to make decisions. So the best part of finance are those things that either help us in projecting cash flows or help us come up with those discount rates. Just very, very, very quickly, weighted average cost of capital, that's your discount rate. We're going to cover that in detail. Capital asset pricing model, as I said, we're going to cover that in detail. That's part of the discount rate. The net present value is doing both forecasting the cash flows and getting the present value. You'll be doing that on your group project. So you will be getting net present value in this class. H model is a discounted cash flow model. We're going to use that in this class. You'll see that late in the class. We are not going to cover alpha, tracking error, and information ratios in this class. I cover it in my risk management class. But it's a way to determine if you're making good decisions and who's managing your money. Are they doing a good job of managing your money? Efficient frontier, we won't use in this class. We do this in my risk management class, but it's essentially a way to make a decision about what assets do you want to buy? Do you buy stocks? Do you buy bonds? Do you buy international stocks? Do you buy high yield bonds or government bonds? So efficient frontier is a way to make that decision about how to most optimally allocate your assets. Now, if you don't want to take my risk management class, but you're really interested in how you should invest your 401k plan, then everything I do in that risk class is on YouTube. You can just ask me for the Excel model and you can do the entire thing yourself without the class. So you can teach yourself a lot of this stuff. So if you want to build your own strategy for your 401k plan, y'all know what 401k is, I hope. When you get your first job, they're going to put money aside for your retirement. You've got to decide, how do you invest that? Do you buy stocks or bonds and what percentages? Efficient Frontier answers that question. Option pricing theory we will not cover in this class, but it's one of my favorite parts of finance. I did this a lot at USAA. I was a big time buyer of options at USAA. So we won't get into that, but it's a great theory. So a lot of the stuff, about 2/3 of this we'll hit, but those are the biggest parts of finance right there. And we will hit, at least at a high level, probably 60-70% of them. There's a few things we just won't hit in this class. There's a podcast that I really like. Patrick O'Shaughnessy interviewed Trey Griffin. And what Trey Griffin said is a good business is one that, first of all, is creating value. That means there's a consumer need for a product. Y'all probably heard this in your marketing classes. What's a good product? It does one or three things. One thing it does is it solves a problem of a consumer. So, they don't like having to pay taxi go to the airport. So Uber comes along and gives them a solution, or they don't like driving to the airport. They've got a problem, something that's an irritation to them, or they have something that adds value to them, makes their life more worthwhile. Maybe it's Netflix and new movies, or it gives them some type of status, like buying a Tiffany ring or something like that. So there's something the consumer looks at and they say, I need this product. So you have some value creation. The second thing is value capture. So value creation is you created something the consumer needs. Value capture is you can price it more than it costs you to create it. That's really important, right? You create something that you can sell for $10, but it costs you $15 to create, you don't have a very good company. But if you can create something that costs you $2 to make, but you can sell it for $10, now you got something. We're going to talk about that in terms of margin, your gross margin, your revenue minus the cost of producing that revenue. And then the next part is scalability. So let's say you build something that costs you $2 to make, and you can sell it for $10, and you got 3 customers a year. Are you going to quit your job for that business? 3 customers? Probably not going to work. What do you need? You need 3,000 customers. You need 300,000 customers. You need scalability. There, we're going to talk about that in terms of turnover and net margin. You'll see that when we get into paper 1, project 1. Turnover is how many customers you can get without a lot of effort. If it takes you a lot of time and effort to get every single customer, you're in a lot of trouble. But if your customers just show up magically, and you don't have to put much effort into it, then boy, you got a great product. And then the net margin is how much does it cost you to maintain the business? We'll talk about those. So what you try to do is find a product that people need, that you can produce at a cost that's well below what people are willing to pay, and you can create great turnover. You can get a lot of customers without having to put massive amount of work into it. Now, scalability, we're going to talk some of the key concepts. One's economic moat. We'll get into economic moat. But another way to think about economic moat is some kind of competitive, sustainable competitive advantage. There's something you have that your competitors cannot copy. Because y'all probably have heard this in economics class. You got a business that's really profitable, making a lot of money. What's going to happen? Well, competitors are going to come in and try to take some of your business away. But if you got an economic moat, you have something to protect yourself from that, and you got a great business. But how much does it cost you to acquire new customers? Some businesses, like a Facebook, it doesn't cost them all that much. Some businesses, it costs them a lot to create the next customer. And then how people heavy are they? Professional businesses like legal services, they're really hard to scale. Because if you add 10% more customers, you got to add 10% more employees. Because you can't just tell your lawyers, hey, just work an extra 40 hours this week. They can't do it. So there's some businesses that are very people heavy. And I mentioned Facebook. Facebook is a very people-like business. Facebook can do a lot with very few employees. So artificial intelligence may be helping some of these legal services. My last will that I wrote, I did it over the internet. And I'm seeing more and more artificial intelligence coming into these businesses. So, maybe artificial intelligence is going to start doing more x-rays for doctors, doing more stuff so that you don't have to have so many people, so many professionals. Education might do that. There's a guy in Singapore, I think he's worth a few $100 million, and he sells online educational tools. He's a teacher, but he's figured out how to scale it. Teaching has been very, very people heavy. As we think of it, you don't want a room full of 80 people, 100 people, but now with the internet and YouTube and all that, one person can teach millions of people and charge them for it. Some of y'all probably have used Khan Academy. Khan Academy, he teaches a lot of people, and it's not that many. You get a sense that he's about the only one out there teaching all the classes. Pretty scalable. So that's what you're looking for in a business. You got something that's very profitable, but you can protect yourself from competitors. You don't have to put a lot of effort into getting new customers, and you don't have to, as your business grows, you don't have to keep adding more and more people. It's very, very scalable. You can think of a business like that. You've got something that's really, really good. I'm going to skip through the ethical challenges, but I do encourage you to read my blog. I'm going to skip through this. You can just read it on your own. But I do think our industry, finance, and especially investing, has some really serious ethical problems, ethical issues that I was just talking to a friend of mine this week, a lady I worked with at USAA. She's trying to decide between her USAA pension and another product. So she sent me the product, and I go, I hate to tell you this, but that is like the worst product ever invented in the history of man. I would never recommend anyone buy that product. That product has one purpose, and it's to rip off the customer. It is a horrible product, but I said, if you want to buy it, you can buy it, but I'm not going to give you any advice on that product because I hate that product. She decided not to look at it. That was a product that was just so complicated. It's impossible to know if it's a good product or not. It's horrible, horrible product. But it's a product built to make the industry money, not to make the customer money. And there's a lot of those examples out there. I will tell you, I'm your professor for life. So if you get to the point where you've got a financial decision, I will not give you investment advice. However, if you want to send me, hey, this guy was trying to sell this to me, you want to send it to me, I'll definitely tell you if I think you're about to get ripped off or not. I won't say I think you should do it or not do it, but I'll certainly tell you that product is horrible. And I know some of the companies that do really, really horrible things. So feel free anytime to come to. Now, if you call me in 30 years, I'll be almost 90 years old. So who knows if I can mentally, you may not be able to trust me at that point, but the next 10 years, I can probably give you some good feedback. All right. So that's it for the introduction, the essence of finance. We're talking about risk versus reward. We're looking at 5-step process of forecasting cash flows and then discounting them. So now what we want to do is a quick accounting review. I can't remember how many accounting majors we have, but we have a few in here. I was an accounting major. So Ashley and Daniela, Daisy, Sergio, Nima. Wow, we got quite a few accountants, about a fifth of the class. Caitlin. So we got quite a few. So it looks like we'll have at least one accountant on each team, which is good. Why is accounting so important? Well, because most of our data is going to come from accounting. Now, I know UTSA has offered a new accounting class for finance majors that's a little watered down. Initially, I didn't like that because I really think finance majors need to understand accounting as well as accounting majors. However, I've kind of come around that it's okay. And the reason is the accounting you get undergraduate, especially for finance majors, is too generic. The accounting you're really going to need is going to probably be very industry specific. So I graduated with an accounting degree. I went to UTSA into their life insurance company. And suddenly I had all these terms I'd never heard of before. I didn't know what a deferred premium was. I didn't know what reserves were. I didn't know what net premiums and gross premiums were, and DAC unloading and all this kind of stuff. So much of what the company was doing, we didn't cover any of it in undergraduate. And so I think finance majors better understand the theory of accounting, the debit and credit, income statement, but understand those basic theories. And really what we're doing is paper 1. That's the level you need to understand. It's pretty high level. But when you pick your industry and you start learning the industry, you're going to find that the things we talked about in this class apply to that industry, but you're going to have a much more specific ratio that we did not use in our class. And so accounting is pretty high level. When you get your job, you got to delve in. And that's what I did at UTSA. I learned accounting for life insurance, property and casualty insurance, real estate, banking. I learned those entities, which is very, very different from what they teach you undergraduate. And they just can't go in that detail undergraduate because there's just too many industries. But there are some key concepts. If you're going to work for a firm like Boeing, you better understand revenue recognition policies. You're going to work for a firm like HEB, you better understand inventory accounting, FIFO and LIFO and all of those. There's really some really difficult things they cover undergraduate that can be extremely key to certain industries. I tell my finance majors, I work on the financial services side. So FASB 133 is an extremely important FASB to understand. They don't cover that undergraduate at all. And it's one you really want to understand if you're going to interview. So we're going to keep it pretty high level, not because, it's still going to help you because the high level gives you really good categories to understand things, to put things in categories so you can classify them. But then when you get out there in the business, you're going to get much, much more detail. So you remember the balance sheet. The balance sheet has assets. Anybody remember the right-hand side?
Liabilities.
Liabilities. What's the rest of it? Owner's equity. All right. So and those two must equal, right? Assets must equal debt, other liabilities, and owner's equity. It simply says is this firm owns things, and here are the people who have a claim on those what the things they own. Some of the people who have claims have a very limited claim, whether it's debt, other liabilities, they just have a very specific claim. And then the owners have a residual claim, whatever is left over. Assets must equal liabilities plus owner's equity. We'll definitely be using the balance sheet in this class. So for the balance sheet, we use the term as of. it is a position statement. The balance sheet is only correct for 1/1000th of a second whenever it was published. So if they publish their balance sheet on December 31st, 2021, it's correct for 1 second at that point in time. The next day, it's all wrong. Why? Because everything's changing values. They collected some receivables. They had the value of something change. Maybe they had some stocks that changed value. So the balance sheet is a position. So the balance sheet's really the key of what does this firm own, who has the claims on it, all right? The other financial statements are period financial statements. We use the term for the period ending. And essentially what they're trying to do is show you how you got from one balance sheet to the next balance sheet, all right? So the balance sheet's the key. That's where we lock in. Everything else is telling you about changes in the balance sheet. Now, how are we getting these values? There's GAAP, generally accepted accounting principles. In my world, we had GAAP and we had statutory. So insurance companies have statutory accounting. That's the accounting that the states require you to follow. It's similar to GAAP, but it has some big differences. So we had to do both statutory and GAAP. There's accounting that's tax-based. So where I worked, we had our GAAP financials, we had our statutory financials, and we had a whole nother set of books for the tax people. Management may have their own internal reporting that they do. We have the international standards. I don't even know where those are right now. I haven't looked at them. It seems like they're moving more slowly. Hopefully you have some accounting class if you're an accounting major that's covering IFRS, where it is. But if you're an accounting major and you're not covering IFRS, there's a chance you're going to come back and relearn a lot of accounting if IFRS ever takes over the US. How different is IFRS versus GAAP? You're going to have to learn that and distinguish that. I don't know if they cover that on a CPA exam yet. Do y'all have classes on IFRS, you accounting majors? Have y'all seen IFRS? I don't know who our accounting majors are here. Look back again. No one's responding. Does that mean no? Daniela? Y'all seen, let's see, got a little in the chat. No and no, all right. So that may be something to your next accounting class, especially intermediate. I remember intermediate, that's a hard class. Intermediate accounting, that's a tough class. You might want to ask your professor at some point, what about IFRS? Do we need to learn IFRS? And just see what their answer is and come back and let me know. I actually want to know. I'm trying to keep track of it. We have a professor at UTSA. I think she's still there, still here. Excellent professor. I've seen her classes because she taught accounting for the EMBA and I was teaching finance. So I'd watch her classes to prepare for my finance class. Really good professor. And I can't remember her name, but she worked for the SEC and her job was the implementation of IFRS in the US. So she knows it backwards and forwards. So she'd be a really great professor. If you're an accounting student and you want to know who that professor is, email me and I'll figure it out and I'll send you her name. You can try to look for one of her classes. You'd really love her. UTSA has great professors, accounting professors, but she's one of the ones that because of IFRS, you may really want to have her class because she knows it better than anybody else because of that. But we are going to use GAAP, not because GAP's the best or it has advantage or anything, but GAAP is the one that firms report to the SEC. It's the one that, it's the easiest to get our hands on. So what we're going to use GAAP financial statements. All right, so those period financial statements, again, they're going to get us from year 0 to year 1, and there's 3 of them. The first one is a statement of cash flow. It tells us how did cash change. Now, something I used to do in this class, but I don't anymore, but it's something every finance major and accounting major should be able to do, is if I gave you the balance sheet and income statement of a company, could you produce their cash flow statement? And you should be able to do that. In fact, the CFA exam, if you take that exam, that's a question they often ask on part 1 of the exam. If all you have is the balance sheet and income statement, could you actually produce their cash flow statement. I've taught classes for the investment society. It shows you how to do that. I stopped doing it in this class just because it gets a little too accounting heavy. But how do you do it? Well, since the balance sheet always balances, the way you get the change in cash is you just make sure you account for the change in everything else. So if accounts receivables went up 10 million, then you're going to have to adjust for that 10 million. You're actually going to reduce cash for that. If property, plant, and equipment went up 50 million, that must mean you went out and bought more property, plant, and equipment for your cash must have gone down 50 million. If your debt went up 100 million, you must have borrowed 100 million, so your cash would go up 100 million. So essentially what you do is you go on every item on the balance sheet and you make sure you account for its change. And as long as you take care of the change of every item on the balance sheet, the sum of all those changes must equal the change in cash because the balance sheet must balance. All right, so the statement of cash flow is essentially doing that. What's the most important link between those two? It's going to be something we call the net working capital requirement. You're going to see, we're going to get into that in very detail. Really, really important concept. The cash flow statement is going to help us with that. The cash flow statement has three components. There's cash from operations, there's cash for financing, and cash for investing. Cash from operations are those cash flows related to the actual operation of the firm. Financing and investing, some people get those confused. Financing are those cash flows where the firm goes out, either borrows money or issues stocks. So it's cash that comes from the debt holders and stockholders of the company. The investing cash flow are when they buy a building or they buy another company or they buy some assets, they invest in the business. That's the investing cash flow. All right, so we're actually going to look at those as well. There's something called CapEx, capital expenditures. That's a big part of the investing cash flow. So CapEx is a number we're going to look real carefully at in project one. We want to know what the firm is doing. How much are they reinvesting in themselves? Is it as much as they've done in the past? Are they cutting back? What's going on with this firm? So we'll definitely be using the statement of cash flow. The statement of owner's equity, it just tells you how owner's equity changed, which is essentially net income, anything you do with shareholders like paying dividends or buying back stock, and then other. We are not going to use the statement of owner's equity in this class. The reason is the only useful information on this statement we can get somewhere else. Like it includes dividends to shareholders, but we can get that out of the cash flow statement. It includes net income. Obviously, we can get net income from the income statement. So we will never use this statement in our class. So you don't have to worry about that one. I don't know many people that actually do use it, but we'll definitely use the income statement. So the income statement is a big part of why net worth went up or down. So we want that detailed. And there's three parts of the income statement: revenue, expenses, and then there's gains and losses. What's the difference between a revenue and a gain? Well, if Ford Motor Company sells a truck, that's a revenue because Ford is in the business of selling trucks. If AT&T sells one of its utility trucks, that's going to be a gain because AT&T is not in the business of selling trucks. All right, so the revenue is what we call normal operations. Gains and losses are those unusual things. You might put this in your notes. We're talking about above the line and below the line. Below the line are those gains and losses, those things that are not normally part of this business, whereas revenues and expenses are the normal things. We'll definitely be using a lot of the income statement in this class, all right? So hopefully you didn't forget everything you learned in accounting. You don't have to do debits and credits in this class, but it definitely helps you to remember those debits and credits. You know, if you increase an asset, that's a debit. You increase a liability, that's a credit. You know, if you remember that double entry accounting, it's actually pretty powerful. I'm doing the accounting for my charity. I set it all up in Excel. I don't use QuickBooks. I set it all up in Excel, and I did it with T accounts. I don't know if y'all remember T accounts. I love T accounts. It's a really easy way to think about a business. And you can essentially just set it up in Excel, just thinking T accounts, and that's how I do it. And we do all our accounting that way. So knowing debits and credits is pretty powerful. Um, if you're accounting major, you're going to definitely have to know that. If you're management or marketing, it's still useful to know that, but you don't have to know it at quite that level of detail. Right. So what I want to do now is flip to the class notes. So everyone, if you can get to Blackboard, let's make sure everybody's on board with this. So I'm going to flip to the class notes. So under Blackboard, you go to, it says class notes and handouts. Just go to that, and there's a Word document that says class notes. You want to load that document. We're going to start at the bottom of page 2. So give me some thumbs up if y'all are finding that. The bottom of page 2, we talked about the essence of finance. We did that in a PowerPoint. So let's talk about the essence of accounting. In the essence of accounting, I don't have to do all that much work because the accountants tell us. That's kind of nice. We don't have this document on the finance side, but the accountants have a document. And talking specifically about GAAP financial reporting, balance sheets, income statements, cash statement of cash flows, the essence of accounting according to the accountants. I'm not making this up. Y'all know FASB, right? The Financial Accounting Standards Board. They're the boss of all the accountants, at least in the US. And they say accounting, the goal of accounting, the objective of accounting, if you want to use the word essence, the essence of accounting, we're talking specifically here about financial statement accounting. I'm not talking about management accounting. But financial statement accounting, the goal is 3 things. Number 1, it's to be useful to those making investing and credit decisions. All right. So accounting does what? They provide information to finance, because who makes investment and credit decisions? Finance. So you see the link between accounting and finance. Accounting is supposed to be the honest, objective, for kind of source of data so that finance can make decisions about investing or lending money. If I were a finance major, I would have that in my wallet. So anytime you meet an accountant and they're telling you an accounting thing that makes no sense to you, you can say, how is that going to be useful for me to make a decision in finance? I used to have auditors talking to me all the time at USAA. They finally stopped because they found me really irritating. But that was the question I'd have. Some Pete Marek auditor wants me to do this kind of accounting. And I was like, how's that going to help anyone make an investment or a credit decision? And they're like, just leave me alone. We're just getting tired of getting sued. Their focus was, we just want to be conservative, but that's not what a GAAP accounting says. GAAP accounting is supposed to be useful for someone to make a decision. The number 2 thing they say is related to number 1. It's helpful in doing what? Remember that number 1 thing in the 5-step process? What was number 1? Forecasting future cash flows. What does FASB say is their objective? Accounting should be helpful in assessing not future net income, but future what? Future cash flows. That's the other thing I used to throw out at the auditors. How in the world would that accounting help us forecast cash flows better? And then the last one is you need to produce financial statements, balance sheets, income statements, those kind of things. You see what I say here? The resources, that's assets. The claims, that's liabilities and owner's equity. And then the changes. What are the changes? That's the cash flow statement, the income statement. All right. So I'm not making any of this up. This is coming, I mean, unless you think I made this up, you can go check yourself. I haven't checked FASB in a while and see if they radically changed this. I didn't edit these to my benefit, except for the parentheses stuff is mine. I took this word for word from the accountants. So this is what accounting is supposed to do. Help us make investment and credit decisions. And I never let the accountants forget it. I think finance has some serious problems. I also think accounting has some serious problems. I think accounting focuses sometimes on the wrong things. And it always should come back to, this is the goal of accounting. Help investment people and creditors make decisions by helping them forecast future cash flows. Everything a financial statement accounting does should be achieving those 2 goals. All right, any accountants want to disagree with that? All right, I haven't heard it yet, but we'll see. Yeah, if y'all bring this up in your accounting classes and they say, oh, but he forgot to mention that, I love having my mind changed. So come in with new data and I'll change my mind. Now, finance wants management producing more cash flows in the future without taking risks. That's essentially what finance wants. Finance wants management to give us more cash flow with the same or less risk. If they can do that, the value of the firm goes up. The problem is there's something we call an agency problem. The agency problem is we're managing other people's money. So management, senior management, is managing the stockholders' investment. And are their incentives aligned? So you probably have heard this, management is supposed to maximize the value of the company to the stockholders. Now, I know there's a big debate about that. I've heard a lot of people badmouth Milton Friedman. I'm a big Milton Friedman fan. You also go out and look at his YouTube videos. They're quite impressive. He's a really great guy, very logical. He's credited for saying the goal of management is to maximize the value of the company. And there's people who say, no, no. Management should maximize value to society or to the employee, or to the customer. And if you listen to Milton Friedman really carefully, he's not saying management should focus on the stockholders and harm the customer, harm the employee, harm environment. He's saying that if management maximizes value to the stockholder, management also will be maximizing value to the employee, the vendors, the customers, to society. He says it's all related. If you treat your employees well, you're not going to maximize the value to your stockholders, because your best employees are going to leave, your worst employees are going to stay because they have no option. If you mistreat your customers, you're not going to maximize the value of the company. So Milton Friedman never said maximize stockholder value at the expense of everything else. What he said is a balancing thing, where you've got to balance them all together, but your ultimate goal is to make the stockholder more valuable. And the wonderful thing is, if you go to the analysis, the companies with the happiest employees, studies have shown, also have the best stock returns. The companies with the most satisfied customers also have the best stock returns. And today we're actually discovering the companies that harm the ecology the least are also becoming the most profitable. That one's kind of a new switch here recently. But we're actually discovering, if you do the studies, that maximizing stockholder value also gives you happy employees, happy customers, and less harm to the ecology. But y'all have classes where you'll debate that, so you can get into that. So management wants to keep their job, though. So they may not want to do what stockholders want to do. Management may not take the risks they should take because they're worried about losing their bonus. And stockholders are saying, hey, do this new thing, go out here, do this, do that. And management's like, well, if I do that, that increase your value, but it might harm my bonus. So I don't know if I want to do that. So management tends to be more risk averse. Why? Because they have all their eggs in that one basket. They're the CEO of that company. If that company does poorly, they lose a lot of money. But the stockholders are well diversified. They're investing in 50 to 100 companies. So they don't have as much risk exposure. So that's part of the challenge. Some of you are in management. This is one of the big issues of management, is how does human resources try to better align management incentives with the incentives of the stockholder. There's a great article I love. If any of you are management or human resources majors, there's a great article on that that I used to use in some of my classes. It's getting a little dated now, where they go through that debate. How do you align management? One thing you can do is give them bonuses based on how the stock price is doing, and those kind of things. Some people ask, is senior management paid too much? I'm in the camp that I think they are in some cases. I do think there's a conflict of interest in that the board of Netflix, their board members are the CEOs of other companies, whose boards are the CEO of other companies, and they're all voting on their management pay package. And they know if they don't vote for a great pay package for this management, they're not going to get it from their board. And so some people have done studies. If you look at senior management pay, It's up a whole lot more than the stock market. And so the question is, does senior management really become that much more efficient and effective than they were 50 years ago? Why is management pay so high? Now, you might disagree with that. You guys are almost too young to remember Occupy Wall Street back in 2008, where people were marching on companies and saying management's overpaid, they're not doing the right kind of things. But that's the debate. Is management paid too much? Boy, there's some people getting paid, $50, $100 million. I remember the guy who destroyed Merrill Lynch and drove it into the ground. He got like $130 million bonus after they fired him. I would have destroyed Merrill Lynch for a lot less than that. You don't have to pay me 130. I would have done it for 10 million. But people are getting paid a lot of money in this business. The other question we'll have to handle is, does management manipulate earnings? You're going to handle this in your project one. I'm going to give you a real quick way to look at that. When does management tend to lie? They tend to lie during really tough times, right? When they're not making much money and they don't want Wall Street to know they're not having a good year, what did they do? They try to cook the books a little bit. And so I'm going to show you some tricks that you can use to try to figure out, is management doing something? We're going to call it quality of earnings. What is the quality of earnings of this firm? It's a great term for you finance majors to know. That's something Warren Buffett talks a lot about. If you've heard of Warren Buffett, he has a reputation for being high quality when it comes to earnings. You can trust his numbers. He's not going to try to hide something or create something. If y'all may not remember Enron that went insolvent back in 2001. Enron was doing what? They were incurring debt, and they were somehow recording it as revenue. And they were tricking Wall Street. Wall Street, they thought they were doing a lot better than they were. So they had very low quality earnings. I worked for insurance companies. A big part of insurance companies' earnings are what we call reserves. I think we have an actuarial science major in this class. Actuarial science majors, they're the ones who establish reserves for insurance companies. They're just guesstimates of what's going to happen over the next 10, 15, 20, 30 years. They can be off by, I've seen companies where over 100% of their net income is a correction in the reserves from an actuary. They said, oops, we reserved too much, we reserved too little. And suddenly in 1 year, there's $100 million that shows up. That should have been spread over the last 6 years. And so some businesses are much more difficult than others. And it really depends on what are those estimates they have to do. So banks and insurance companies, their earnings are very unreliable because there's so many estimates in their earnings. A big chunk of their earnings is just pure estimate. And so you're kind of like, boy, they make a small change in their estimate, their net income could triple. So that's definitely an issue. Hopefully they're being honest. They're telling you what they really believe. They're not trying to cook the books, but they have a lot of wiggle room to be able to do that. Warren Buffett doesn't like companies like that. The other question we have a lot is, do management and stockholders, are they too focused on the short term? I've got a really good article on that one as well. There's a lot of debate on that. I think the most recent research is coming out to show there's pretty good evidence that stockholders are much more long-term focused than you might think. And the way they do that, they look at management announcements that are, aren't going to impact the firm for say 5, 10, 15, 20 years. And they assess how Wall Street interprets that. So management might announce something that's going to actually harm earnings the next year, but long-term is going to be good news. And they found that stockholders in valuing the company actually do a good job of handling that. They're not entirely focused just on the short term, but there's some debate about that. So some people are wondering. Well, we're going to stick with the model that we're really focused on the stockholders. Not that you have to do that, but it just makes this class much more straightforward. And then when you take your other classes, you can talk about those other stakeholders in the business. I think there is another agency problem, and that's Wall Street versus Main Street. That's where you can read my blog and see where I really think there's some serious conflicts of interest in this industry. Right, real quick, careers in finance. if you ever are wondering if you're in accounting and finance and actuarial science, those three in particular, anytime, give me a call and I can walk you through. I've done some career and finance classes for the Investment Society. I wasn't thinking about doing it this semester, but I have in the past, where we have outside people come in and talk about that. I really view it from, do the corporate finance route, or do you want to be the investment route? And those are two very, very different fields, but they're using all the same data and nomenclature. It's not like they're two different, radically different worlds. They're both using discounted cash flows. They're both using accounting. So I started in the corporate finance world. I actually prefer that for most finance. If you're like, I don't know what to do, I mean, to me, it's obvious, do corporate finance. There's thousands of companies out there. Find a company you believe in and start interviewing with them. Firms are hiring left and right. This is a really great time actually right now to be looking for a job. Find a company, go work for that company, and then learn that company backwards and forwards. So I went to USAA. The most important part of USAA is the actuaries. So I made it extremely important to my career that I interacted with actuaries every chance I got. Any excuse I had to talk to an actuary, I talked to an actuary. If you're going to work for Valero, you better get to that trade desk and start talking to those traders. You better talk to the engineers, petroleum engineers that understand this business. So on the corporate finance side, your goal is to go find a company in the industry and then learn the hardest part of that company. Go find the most technical people and interact with them. If you do the external side, you become a security analyst or portfolio manager. You're on the investing side, whether it's on the buy side or sell side. There, what you're going to be, you be more of a generalist. So you may be covering 10 industries. And you're going to learn them at a higher level. That's why I prefer the corporate finance side. If you really want to learn a company, you're going to have to go work in that industry, in the company. It's really hard to learn insurance or banking or refining or technology if you're working for an investment firm like JP Morgan and you're being taught kind of generic stuff. You really got to go learn the company. There's, with me at USAA, beyond, someone brings me a number from an actuary and I say, okay, I don't understand this number. So I'm going to go talk to that actuary. And boy, they loved talking to me. It was pretty amazing. I'd be over there for 2 or 3 hours. No one ever talked to them. And here comes this kid over and like, wow, I'm really impressed how smart you guys are. Tell me your job. And they were more than happy to sit down and tell me everything they did. And I learned that that was the most important part of insurance. If they mess up, the whole company goes under. Very technical, very mathematical, but I learned it just backwards and forwards. And that really helped my career. That's why I prefer the corporate finance side. Those people don't exist on the investment side. You're not going to go to JP Morgan and learn about insurance by talking to an actuary. You're going to talk to a bunch of investment people that know insurance. So if you're not sure either way, I say go corporate finance. But here's the key for your career in finance. And I think this is true for everything else too. It's specialization. The more complicated, the more you get paid. That's why I tell students you got a choice between 3 jobs. Which one do you pick? Pick the one that scares you the most. The scariest job is the one you want to learn. And you're all honor students, so you're all really, really, you're the top-notch students at UTSA. You especially need to do that because sitting there 40, 50 hours a week, you're going to learn it. It may be really tough the first few weeks, but eventually you're going to learn it, right? It's not going to be a problem. You're very, very smart people. And you actually want that. You walk into the job and you're scared to death. I've had students, their first job, they were teaching their boss 3 months into their job. And I tell them, you need to flee that company like it's a sinking ship. If you're teaching your boss after 3 months and you're right out of college, you're in the wrong job. My first job in finance, my boss scared the life out of me. And boy, am I glad I took that job. He was a type A personality. He came in, if I said something stupid, guess what he would do? He would tell me, you just said something stupid, Ron. And boy, I learned so much from him. So specialization, you got to learn hard stuff. First of all, it's more fun. Secondly, you get paid a lot more money. And third, you add a lot more value. People start, the last several years of my career at USAA, I never applied for any jobs. I just got phone calls. Ryan, come work over here. We need you here. You get your reputation out, you learn stuff, and suddenly people are just calling you to offer you jobs. So if you have questions on careers, man, give me a call. I can certainly help you. There are a couple of exceptions on the extreme specialization: cybersecurity, decision science, those type of things, where the specialization is in the discipline itself, not in the industry. Yeah, if you're doing decision science, then you need to be learning statistics, Python, SQL, those kind of things. Cybersecurity, I know nothing about IT, so don't ask me. So I'm pretty stupid on anything IT, but there you're learning a specialization, which is the discipline itself. In finance, the specialization is that industry. It's those high quantitative people in the industry that understand stuff that it's really hard to learn. Any questions on that? Now, I know some people who became finance majors because the accounting classes were too hard. That's not a good way to pick finance. Why do you pick finance? What's the difference between, I've done both of these. So what's the difference? Accounting is principle-based. It's GAAP rules. There's somewhat of a balance between logic and compromise. Not everything accounting does is logical because there's some compromises. Finance is theory-based. It's concepts. It's ideas that are generally true, all have serious flaws with them. All right. So my first accounting job, I knew what I was supposed to do every minute of every day. There was no uncertainty. It was rules-based, debits and credits. I was doing debits and credits all day. I was providing information to decision makers. The stress was the workload. I had to have everything done by +3 or whatever. I did a lot of reconciliations. That was my accounting job. It was a good job for me to start with because I was scared to death when I graduated. I was like, I can't do this. I picked the wrong degree. What am I going to do? So it was nice to have a job where everything was clear cut and spelled out for me. And then I jumped into finance. And I go, okay, what do I do, boss? My boss said, well, read your job description. My job description said, make USAA more valuable. And he said, do that. And like, what does that mean? He said, well, you figure it out. That's why we hired you. Fortunately, Lisa was in that department and she helped me know what to do and where to go. I'm still really good friends with Lisa today. You create those networks in those early jobs. And I figured out how to add value, and that's what I was doing. I love the finance a lot more than the accounting for that very reason. At the end of the year, I can say, hey, I had these 6 projects and they added this many millions of dollars to USA's value. I couldn't do that with the accounting side. The accounting side, I was providing information, other people were making decisions, and I was just assessing those decisions. So it kind of depends on where you want to be in that. And I didn't realize I had this issue with my ego. I want to be in the middle of decision making. That's just where I wanted to be. It's much more stressful. The stress comes that your decision is terrible and people lose a lot of money. Yeah, you lose a lot of sleep. I lost a lot of sleep in 2008. In finance, you read a tremendous amount. Now, today it may not be reading, it might be listening to things, on Audible or whatever, but you're always looking for new ideas. So that's accounting versus finance. I can probably talk about finance versus actuarial science or decision science. Even marketing. I spent a lot of time with USA's marketing department. So feel free to call me if you have questions on careers. Any questions up to that point? It's good. All right. Hopefully there's none of you that were like I was, like, my word, I have no clue what I'm going to do the rest of my life. I sure hope accounting is the right career. But it's scary, right? You're making decisions for the rest of your life. You sure hope it is right. But if you find your classes interesting, I found my accounting classes interesting. I should just relax. If you find your classes interesting, then you're fine. If you're bored to tears in accounting classes, or you're bored to tears in your finance classes, you shouldn't be an accounting major. You shouldn't be a finance major. All right. The classes really are the same type of stuff that you're going to be doing on the job. So, all right, let's continue with this accounting review. So we already talked about the financial statements. The general overriding criterion for accounting, as we said, is decision usefulness. So useful to investors and creditors. Accounting says there's 3 ways you're going to assess whether or not accounting's meeting that objective. Is it relevant? Is it reliable? And is it comparable? Okay, relevance means it's helpful in making the decision. Does it have predictive value? What that means is, does it help you actually forecast future cash flows? Does it have feedback value, which means I've got this forecast that I did for Netflix, and I just got their quarterly financial statements. I see some errors in my forecast. I'm going to correct it. It gives me some feedback on that. All right. And the last one is timeliness, something accounting has gotten really, really good at. Timeliness. When I started at USAA, our financials were like +10. And they've quickly got down to +3. I think they're at +1 now. They just keep getting faster and faster and faster. I think Google says they're +0. Every day they produce their financial statements. So timeliness. Accounting is getting really good at timeliness. Why? Because we have all these computers and everything else going on. So timeliness. Those are the 3 criteria that say accounting is relevant. +10 means, Dante, we have to have, it's 10 business days. So you need to have everything done by the 10th business day of the month. +3 means you have to have everything done by the 3rd business day. And +0 means you have to have your financials done today. So if it's March 31st, you're doing first quarter financials, you need to have them published on March 31st. That's timeliness. Reliability is there's no errors, or there are not too many errors. So it needs to be verifiable. That's where the auditors come in. It needs to be neutral. You don't want management with biases or errors in the numbers. We know they're there, but we need to have it at a point where it's not just so unreliable, it's useless information. So it needs to somehow faithfully represent what's actually going on. It must be factual. Now, some of your accounting majors may become auditors. I still have contacts. I actually know the head of auditing at USAA. She just hired one of my former students. I was teasing her about audit, so she can take ribbing about auditors. I'm not a big fan of auditors, and she remembers me like that. But she's a really good auditor. She knows what she's doing. But that's her job. She's an internal auditor, and she works with the external auditors. Their job is to make sure everything that company does, you can rely on. It's information that when you see it, it's like, okay, it may not be perfect, but there's not any massive errors in there. How reliable is accounting now? I think it's more reliable now than it was, say, 20 years ago. However, I do think the accountants are getting a little too fancy with some of the fair value accounting, that they're actually incorporating some accounting principles that's actually putting some noise into accounting. There's a new accounting pronouncement. I cannot remember the name of it. It's not 133. 133 is the derivatives, but there's a new one. If you're a finance major, you really should learn this one. You're going to interview at JP Morgan. So if you're interested, email me and I'll find it and I'll send you the FASB. But it's related to how you value investments. And they have 3 levels: level 1, level 2, level 3. If I were interviewing for a job in finance, I would, especially on the financial services side, whether it's a bank or an insurance company or an investment firm, I would definitely know those 3 levels. That's really important to that industry. It creates a lot of noise in the accounting. And in my opinion, it creates so much noise, it really makes it hard to rely on the financial statements. So I think the accountants are somewhat, they're trying to get more accurate and they're trying to get more reliable, but in the process, I think they're making things just more complicated. But that's the debate. You can certainly have that debate. And then the last one is comparability and consistency. Comparability is you can compare your company to other like companies. You can compare McDonald's to Wendy's and this Sonic. Consistency is you can compare your company to your company over time. All right. How comparable and consistent are companies? I think accounting has some serious problems here. And not because accountants aren't really smart, it's because companies are really complicated. So I just mentioned comparing, let's say, comparing McDonald's to Jack in the Box.
Hello.
They're both restaurants, right?
Oh, I'm sorry. Okay, I thought they meant to leave. Okay, I'm sorry. I'll be right there. All right.
Someone mute. Make sure you're all on mute. All right, sorry about that. the joys of Zoom, right? All right, so McDonald's versus Jack in the Box. See, that's comparable. Are those two companies comparable? What does McDonald's do that Jack in the Box doesn't do? Anybody know that would radically make these two companies very different? Any guesses on that?
Expand to other countries.
Other countries, maybe Jack in the Box is probably just in the US. That certainly could give you some currency issues, and currency accounting is really tough. So I agree with that. That would cause some issues. That's not the one I was thinking about, though.
McDonald's is also in the real estate market.
Real estate definitely could be in. I don't know between those two how McDonald's does that versus Jack in the Box. I think Jack in the Box probably owns its stores, but I don't know. That would be a key one to look at. All right, y'all, those are both really good points. The one I'm thinking about is franchise versus non-franchise. What if you don't franchise? Your revenue is all the revenue of all those stores. But what if you franchise? Your revenue is only what? The royalties from those stores. So if you look at McDonald's, their revenues look really low versus Jack in the Box. But why is that? Because McDonald's is just getting the royalties. They're not getting, everything else. And this has been a big debate with McDonald's. Governments are asking McDonald's, how many employees do you have? And why do they ask that question? Because they want to provide healthcare and all this other stuff. And McDonald's says, oh, we don't have that many employees. Our franchises have employees, but we don't have employees. And what are governments saying? No, you have employees. You fall under these rules, but there's a lot of issues. Uber is going through that same issue, right? Uber says, hey, they're not our employees. These are contractors. They're gig economy. They don't work for us. And what does the UK say? No, they're your employees. You got to give them benefits. That has big implications for accounting. How does McDonald's account for things versus so let's say you pick McDonald's, and you can't do McDonald's because they're one of the companies with negative net worth. But let's say you pick McDonald's as your company and you're comparing it to its industry. You might notice, wow, McDonald's turnover ratio is really, really good. They're so much better than the industry, but it's not that they're better than the industry. It's just they're very different. You got a franchise model versus a company-owned model. Makes it really hard to compare these two companies. So be aware of that. Over time, it can get tough as well. Why? Some of you are going to struggle with this on project one. You're going to look at a company that did a major acquisition 3 years ago, and their revenues jumped 40% all in 1 year. That's kind of irritating. So one of the things you're going to look at is their revenue growth. Wow, their revenue growth was really strong. Well, was it really strong, or did they just acquire another company? And you'll have to make that adjustment. All right. So that is going to be an issue. How do you handle those issues? You just acknowledge them, put them in your paper, and you move on. Okay. Remember, one of my goals in this project one is to make sure you're aware of just how complicated the real world is, and do your best to try to handle them. Sometimes you just have to put down what you know and move on. All right. All right. I'm going to stop it there. Next class, we'll finish up the accounting review as much as we can. And I'll start here. We'll talk about the balance sheet some. One real key on the balance sheet is we're going to get into this net working capital requirement. Extremely important. It's probably the hardest part of project one. So be engaged, be ready to go. Any questions on anything on the class? This afternoon, I'm going to go up to UTSA and get all the data for the company. So this weekend, you'll have the final data. I'll send you a YouTube that shows you how to bring that data into the model. So you can be ready on Tuesday. Very, very important on Tuesday. This is the kind of class, you've got a really tough project. It's got some stuff in it that's gonna be a little uncertain. If you just listen to the class and then say, I'll do the project later, I mean, I can just tell you this is true for everything. When you're listening to it, you say, yeah, I understand it. And then 5 days, 10 days later, it's like you've never seen it before in your life. So you really want to be focused on it while we're doing this. You want to be looking at your company while we're going through it. All right, just really, really important. So I'll send that out with my weekly email. I'm sorry, I'm a little distracted because of this waiting room thing. Really strange. All right, so we're going to continue our accounting review, and then next week we'll definitely be getting into the project. So the accounting review, we're going to break it between the different financial statements, starting with the balance sheet. We'll be using the balance sheet in project one. It shows you what the firm owns and then who has a claim on those things. So the elements of the balance sheet are obviously assets. Yeah, I'm still omitting people, sorry. Assets, liabilities, and owner's equity. Under assets, the traditional approach is to talk about current assets and non-current assets. Finance doesn't think about it like that. All right, man, very few of y'all are on videos. So, okay, there's a few of y'all. All right, so what do we do in finance? So this is really critical. This is the hardest part of the entire project one. It contradicts what you were taught accounting. So we're going to have this issue with accounting versus finance and how you look at things. I do want you to learn it the finance way. I also hope when you go through your accounting class that you'll challenge your accounting professor, and I'll show you how you can do that. And then I hope maybe one of these days that we'll have like a public debate between me and one of the accounting professors on this issue, because it is an area where there's ratios you learn in your accounting class that we never use in finance. All right, we don't like them. We don't think they tell us anything. So the account is focused on current assets. We don't focus on current assets in finance. Why is that? Well, what we're interested in is not that they're current assets. What we're interested in is they're tied to operations. There are some current assets that are directly tied to operations. So what do I mean by that? I assume you all know what accounts receivable are, right? Can anybody give me a quick definition of accounts receivable?
It's the money they owe you in short term.
So who owes you? Is this, there's a customer?
I mean, it's the money you are waiting to receive.
From a customer, right? So money you're waiting to receive from a customer. So it's not like you loan someone money and it's debt that they're going to pay you back. Is they bought something from you, but they didn't pay you at the point that they bought it. Instead, they gave you an IOU. So that's your accounts receivable. It's directly tied to what? It's directly tied to revenues, right? That's part of your operations. Inventory. Is inventory tied to operations? Absolutely. What are you selling? You're selling your inventory. Inventory is directly tied to your operations. Prepaid expenses. The most common prepaid expenses might be a lease on a building. That's usually directly tied to your operations. But cash, is cash tied to your operations? And in finance, we say no. Cash is the result of your operations. Your operation produces cash. But cash is not an operating asset. So we make a distinction between cash and other short-term instruments and these other three: accounts receivable, inventory, and prepaid. All right. So you'll see we're going to get into that here pretty quickly, and we're going to spend quite a bit of time on it. So don't freak out if you don't get it the first time. It is the toughest part of the paper, and it's one of the first things you have to hit. Non-current assets. In this class, we're not going to get too picky on them. Probably the only one we're really focusing on the operating assets. You might know it as property, plant, and equipment. They're recorded at net book value, which is what the cost is minus depreciation. It's not a real economic number, but it actually can be a pretty valuable number. When I look on the balance sheet of, say, NVIDIA versus Intel, I notice that NVIDIA has very little property, plant, and equipment, but Intel has a lot of property, plant, and equipment. And you think, well, they're both semiconductor companies, right? But NVIDIA is a developer, an inventor. They don't actually produce the semiconductors. They develop them for somebody else, and probably in Taiwan to produce them. Intel actually had those massive, I don't know if y'all have seen some of those things, those massive fabrication plants where they produce all those semiconductors. So you think, well, these are two companies that are semiconductors, but boy, their balance sheets look really different. And that's one way I like to look at it and say, what's on the balance sheet? We mentioned Jack in the Box versus McDonald's. Well, if you're a restaurant and you own all your restaurants, that gives you a lot of property, plant, and equipment. If you're a restaurant and you franchise all of your restaurants, you're not going to have that property, plant, and equipment. So just looking on that line can tell you a lot about the business. We're not going to spend any time at all on other financial instruments. That was a big deal for me at USAA because insurance companies have a lot of longer term financial instruments. If you go look on Apple's books right now, they have a lot of that just because they're just sitting on a lot of cash. And instead of having it sit in cash, they decided to invest it a little bit longer term. We're not going to talk much about intangible assets, but it can be interesting. Does the firm have a lot of goodwill? Do they have patents and trademarks? But we're going to ignore intangible assets for the most part. So that won't be a big part of it. There are assets the firm has that really don't exist anywhere on the balance sheet. Brand identity. Coca-Cola has a great brand identity. Google has a great brand identity. Did you know that you can actually value that? You can actually go out on Google and Google brand identity value, and there's firms that actually will tell you how much does Google's brand add to the value of the company. How much does McDonald's brand add to the value of McDonald's? How did they do that? Well, the way they do that, we're going to talk about margins, gross margins. They look at the gross margins of, say, Apple versus the gross margins of, say, Samsung. And if Apple has bigger gross margins is your revenues minus your cost of goods sold. They're going to say Apple has bigger gross margins because of a better brand identity, which means they can charge more for their products. So the value of brand is essentially the present value of all those higher gross margins. Now, if you go out and Google it and you bring up brand values, what you're going to notice is that 2 or 3 different firms are going to have radically different valuations for Google's brand value versus Apple's, because it's not an easy thing to do. It's a pretty tough calculation, but that is out there. So there's people out there to say not only is brand important, but we think we can actually value it, but the accountants will not value it. It's too subjective. Employee training. USAA had wonderful employee training. I learned a lot taking their classes. It cost them a lot of money to train me. I remember some of my favorite teachers they had there, really, really great people, very smart. They would train me. That probably is going to benefit USAA for 3, 4, 5 or more years. I'm not going to forget all of that. And yet on employee training, they don't set it up as an asset that they amortize. Instead, they expense it all the same year that I took the course. So you think of an asset as something that has value for more than a year. Employee training should have value for more than a year. And yet GAAP accounting says expense it all immediately. Some of y'all may have this issue. I just mentioned semiconductor firms. A lot of firms have a heavy research and development expenditure. GAAP accounting has been changing on this. It's one of those things you probably want to research on. But GAAP accounting, for the most part, makes you sense these now, although it's possible some firms can actually, y'all know what the word capitalize means? You have something where you spend money, but instead of expensing it through the income statement, you instead set it up as an asset on the balance sheet and you depreciate it over time. That's what capitalize means. So some firms have heavy research and development costs. That's actually not going to be an asset for most firms. That just go as an expense in the income statement. There are some assets that GAAP records that are pretty questionable. Goodwill is one finance really hates. What is goodwill? Well, a firm buys another firm, and the other firm's GAAP net worth is 50 million, but the firm pays 70 million for that firm. And the accountants say, okay, we say the firm's worth 50, but they just paid 70. We got to do something with that extra $20 million. So some brilliant genius in accounting said, hey, let's create this new account and call it goodwill. You paid an extra $20 million. We'll call it goodwill, and we'll just amortize it over the next 40 years or whatever. Finance doesn't like it because it's just a pretty questionable number. Now, you do have to be careful on goodwill. If you show goodwill on your balance sheet on a company that you know is really not worth what the company paid for it, let's say you pay $70 million for this company, and their GAAP balance sheet only showed $50 million, so you set up $20 million of goodwill, and a year later, you find out that was a really bad purchase price, you actually have to write off all that goodwill. So accounting says, if you know the goodwill is bogus, you got to write it all off. But otherwise, you can just let it ride. I'm always interested if a firm has a massive goodwill on their balance sheet, because I'm kind of curious, what do they do? There's some Hewlett Packard's a good example of a firm that was acquiring a lot of firms that they later discovered they had overpaid for them. And they were having to write off a lot of their goodwill. So it can be interesting. Finance, we're going to ignore goodwill in this class, but finance does one of two things. They either ignore it like we are, or they actually write it off entirely. You just take it completely out and just write it off to zero. So there's two ways to do that. In fact, if you go on Yahoo Finance and look at the balance sheet, they'll show you two net worths. One net worth is what GAAP says, and the second net worth subtracts out things like goodwill. So you can go either direction. We're somewhat going to ignore that. Many assets on GAAP, they just put a value on the books based on what you spent initially. They're not trying to tell you what the assets were today. You look on USA's balance sheet, they've got this massive number, probably $1.5–2 billion by now, for property, plant, equipment, because USA has a fairly decent sized building, wouldn't you admit? And the amazing thing is they don't have enough space, even with all that space they have. They're just crashing. They're having to rent buildings all over the city. That's a massive, massive building. That might be on USA's books for $1 billion. They're not saying the building's worth $1 billion. They're just saying that's what we paid for it, minus what we depreciated. Could you even figure out what that building's worth? Who would buy that building if USA decided to move somewhere? It'd be pretty tough, right, to come up with a market value for that building. There's not too many people. I don't think HEB could move in there, or maybe UTSA could buy that building. That'd be pretty big for UTSA as well. So it's a pretty massive building. So it's hard to say what would the true market value of that building be. So GAAP says forget that. We'll just put it on the books at what you paid for it minus your depreciation. All right, y'all interrupt me if you have questions on this. Hopefully this is a review of what you saw in your accounting classes. On liabilities, the same thing on current liabilities as I said with current assets. Some current liabilities are tied to operations, some are not. So accounts payable and trade payables, that's usually related to the firm's buying inventory that they're going to sell. That's directly tied to operations. Your other accrued expenses are like you owe money to your employees. That would be an accrued expenses. So like at USA, we worked for 2 weeks, and then the week later they paid us for those 2 weeks. So for about 3 weeks, USA owed us money because they hadn't paid us. We worked, but they haven't paid us yet. That would be an accrued expense, be salaries payable. That we consider to be part of a liability is tied to operations. Now, there's one I left off that's extremely important, so I want you to add this to your notes. Extremely important. I don't know why I left it off. We'll definitely talk about it. It's unearned revenue. So what is unearned revenue? And a lot of times it's the mirror of what we saw up on the assets. We had prepaid expenses. So what is an unearned revenue? Let's say you live in an apartment complex. I'm betting when you pay your rent that they force you to pay it before the first of the month. Right? You don't pay your December rent on December 31st, I would guess, unless you have a really unusual apartment complex. So when do you pay your apartment rent? You might pay your December apartment rent on November 28th. Well, you haven't stayed in the apartment yet. So you gave them money for something that they haven't earned yet. You're paying your apartment rent on November 30th is a prepaid expense for you on December 1st, because you pay for the right to stay in that apartment for 31 days. So that would be an asset to you, but to the apartment complex, you paid them rent for December. You haven't stayed in the apartment for December. So on December 31st, on November 30th, when you pay your rent, that's an unearned revenue for that apartment complex because you haven't used up that rent that you paid them. All right. So unearned revenue for some firms is incredibly important. Airlines is a horrible industry, I think, from a financial standpoint. Especially COVID has really been tough. It's an industry that's really struggled to make money. But one thing they have that is really, we're going to talk about, this is actually a good thing. One major thing airlines have is unearned revenue. If I want to fly to Costa Rica in May and I buy an airline ticket today, guess what that's going to be to the airline? That's an unearned revenue. All right, so y'all ready for me to blow your mind? Is this a good thing or a bad thing? The accountants say it's a bad thing, current liabilities. We want a lot of current assets and we don't want current liabilities. Finance says, wonderful. Why do we like that? If you're running a apartment complex, would you rather your customers pay you on November 30th or pay you December 31st for December's rent? Which would you prefer? Any of y'all prefer December 31st? If so, you probably need not be a business major, right? If you don't like, yeah, before Isaac, I'm with Isaac. I want my money in advance. First of all, it's safer because I know I got their money. Second off, I've got their money now. I can do whatever I want to with that money. I can invest it. I can pay other bills. So finance says this is a wonderful thing. Your accounting classes told you this is a horrible thing. So we're going to have to figure that out. Same thing with accounts payable. We love accounts payable in finance. Accountant says they're terrible. We love accrued expenses. Accounting says no, they're terrible. So I'm adding unearned revenue. It's a pretty major one for several industries, so we do need to put that in there. What's the one I didn't cover is debt. Debt is a current liability. The current part of your debt, what you owe in the next year, is a current liability, but is not tied to operations. All right. You think about operations, you have revenues, you have cost of goods sold, you have other expenses for other employees. That whole process either produces cash, so you have cash on your balance sheet, or it eats up cash, and then you have to go out and borrow money. So cash and account and debt, cash and debt are outside of operations. Operation causes you either to get cash or to have to go borrow money. So cash and debt are not operating assets. So you're going to see in finance, when we look at current assets and current liabilities, we separate out cash, we separate out debt as not the same as these other items. Okay, and there may be a few others, like if you have taxes payable, I don't consider taxes to be an operating asset or liability. So there's other things for our purposes. We're not going to just look at current assets and current liabilities. We're going to look at the current assets that are tied to operations separately from cash. We're going to look at the current liabilities that are tied to operations separate from debt. Okay, any questions on that? Because that's pretty critical, although we're going to keep going over and over and over it. You can see some furrowed brows, so I know you're not like 100% on it yet, but you'll see as we get into it. We're really going to cover it a lot. Your non-current liabilities, obviously debt that's not owed within the current year. Capital leases, I really like what GAAP accounting is going to do with capital leases. Essentially, they're going to convert almost all leases to be capital leases. So if in your accounting classes, you might have learned operating leases and capital leases. Not a big deal for what we're doing here, but it can be important for some companies. Most of your companies probably won't be a big deal. But a capital lease is you're leasing something, you're renting something, and you have such a long-term commitment, that lease looks a lot like debt, because maybe you have a 5-year lease, looks a lot like debt. So the accountants say, you know what, you owe someone money for 5 years. Boy, that looks more like debt. We're going to set that up as a liability, real similar to debt, and call it capital leases. Some other liabilities.
Can I ask?
Yeah, go ahead.
So on the capital leases, like, does it have to meet a specific monetary threshold to be considered a capital lease, or is it just that time frame?
The accounting rules on this have changed, and I have not checked them because I've never worked for a company that had capital leases. So we're in the right middle of the flux. I should probably look that up. If one of y'all covered this in your accounting classes, let me know what the new rules are. In the past, there were very, very specific rules on what's a capital lease, what's an operating lease. I used to get calls at USAA. This one guy called me every year asking if USAA would want to sell its home office and lease it back. And they would set it up in a way that we were just barely under the rules for a capital lease. And that's the problem with those accounting rules, is once they set those rules, the people who do these leases, they would make sure you're right under the rule. So you could show it as an operating lease and not a capital lease and have to set up all of that liability. So there's been so much gaming with the rules. I think the accountants have finally said, let's just treat them almost all as capital lease. So I'm not sure. I don't know who asked that question. It's a very, very good question. Something to learn in your accounting classes, right? Especially, this is an intermediate accounting issue. So if you're not an accounting major, you may never see those rules, but you could definitely Google GAAP accounting rules for leases, and you'd probably find a pretty good Wikipedia page that would explain it. Pension plans, benefit plans. That was my thing. I ran USA's pension plan. The accounting rules on that have changed as well, and they're far better today than they used to be, but incredibly complex. And they're so complex that when you see a liability, a pension plan is an employer is promising to pay their employees an income for life once they retire. So it's a really, really long-term liability. And because of that, how much you put it on your books is really, really important. What discount rate do you use and those kind of things. Those rules have gotten better, but they're still extremely convoluted, very complex. The benefit we have today is very few firms have pension plans anymore. So it's tending to go away, but a lot of old economy firms like a Boeing or some of the telecommunications still have massive pension plans. So that could be a really huge liability on your balance sheet. Deferred taxes. I hate deferred taxes. I just think the rules are insane. When you take intermediate accounting, I think you might agree with me. Let me know. I don't know who in the GAAP and FASB, well, I don't know what they were smoking when it came up with the deferred taxes rules, but boy, they were on something that made them go as complex as possible. I don't know why accounting went that complex. On something like that, most people just say, I'll just take it like it is. The rules are so complex. It's usually not a big number, but that's the struggle accountants are having, is they're dealing with stuff that's really complex. They got to come up with rules. And sometimes I think they go a little overboard, but deferred taxes, it's kind of a strange thing. Deferred taxes is not taxes you owe the IRS. So it's not like we owe the IRS $10 million and we'll pay them March 15th. Deferred taxes is something that would be taxes payable. That's just an accounts payable. Deferred taxes is a incredibly bizarre animal. There's some other obligations that the firm will put on their books, but are going to really be based on assumptions like warranty costs. And as I mentioned, benefit plans. Those can be really material. I worked for an insurance company, and 90% of their liabilities were these estimates. And those estimates were plus or minus 3%, which means their net income could be off 100, 200, $300 million easily just by small differences in those assumptions. So some businesses, that's a big deal, and you'd really want to watch that. Banks have bad debt reserves, right? Banks loan a lot of money. So if you're looking at a bank, you really want to understand their bad, I forget the exact term they use, but their reserve for bad debt. In a year like 2008, when you have a lot of firms going insolvent, you really want to know what is the bank doing so they can set up that reserve for those loans that may be currently paying, but they don't think they might be paying a month or year from now. So those are all estimates based on all kinds of historical data and all kinds of things that can be pretty material, and also leave a lot of wiggle room for management to manipulate numbers. GAAP has specific rules on what you have to put on the balance sheet. And one thing they say is you cannot put something on the balance sheet on the liability side. You can't put it on the balance sheet unless you believe there's more than a 50% chance of it happening and you can quantify it. If you think it has less than a 50% chance, or these both have to be true for you to put on the balance sheet. But if either one of these is false, you can't put it on the balance sheet. So if it has a less than 50% chance of occurring, you can't put it on the balance sheet. Or if you can't quantify it, you can't put it on the balance sheet. So several years ago, the tobacco companies were being sued by every state, billions and billions of dollars. So they have a lawsuit, and they have this painful thing they have to do in GAAP. They have to sit down and figure out first, what's the probability we're going to lose this lawsuit? And then if we lose it, how much will we pay? Do you think there's any plaintiff lawyers that would like to know that information? So GAAP requires them to do that analysis, and they have to discuss it in their footnote. Boy, that's information I wouldn't want the plaintiff lawyers to know, but that's what you have to do. So it's possible you have a firm with a major lawsuit, and they don't have that anywhere set up on their balance sheet as a liability. Why? Because they think they have a more than 50% chance of winning, or they have no basis for figuring out how much they would lose if they lost the lawsuit. So, and then other firms have what we call off-balance sheet obligations. When Enron made that a really bad term, and but they're not that bad. USA had off-balance sheet obligations because they had some catastrophe bond reinsurers. The auditors asked about it. They questioned them on this. Shouldn't this be on your balance sheet? And USA argued no, but it's an interesting entity. USA has this entity that only it's an insurance company, but USA doesn't own it. USA says it's a separate entity. USA doesn't own it, but this entity only has one customer, and that's USAA. So the auditors are saying, wow, you've got this entity whose only insurance customer is USAA, but you're saying it shouldn't go on your balance sheet, and USA says, no, it shouldn't go on our balance sheet. So you see those kind of things. Are they cooking the books? Are they doing something? No, if you listen to it, it's perfectly fine. Your 401k plan, you're going to have a 401k more than likely, right? It's your retirement money you're going to invest. For firms, they don't put that on their balance sheet as a liability. They just say, hey, that's your money. It's in a trust. It's not part of our money. They don't show that as a liability. But auditors might ask that. Should we put your 401k plan on your balance sheet? All right. So these can be interesting. You might want to look into them. There's often a discussion in the footnotes on these kind of things. So they can be material. So there's the balance sheet. Our real key of the balance sheet are going to be those operating assets, operating liabilities. We're going to really get into that in detail. And then finally, there's owner's equity, which is just everything else, assets minus liability, also known as the book value of the firm, also known as shareholders' equity. Some people call it net assets. There's all different terms for it. Book value is a good one to know. You'll hear book value quite a bit. So if you hear the term book value, it just means the net worth of the firm. Net worth is another term. Owner's equity. I don't know what they use in your accounting class, but sometimes in finance, we have 10 terms that all mean the same thing. And this is one of those cases. We have so many different terms. And you got to be careful. When I use the terms, if you hear me say net worth, or owner's equity, or shareholders value, or book value, I mean the exact same thing for all four of those. But I don't realize I'm doing that, right? So you'll just have to get used to the nomenclature. I don't know if y'all remember what your accounting classes called it, and they may have called all of those things. All right, there's the balance sheet. Let's get into the flow statements. These are the ones that tell us how we got from one balance sheet to the next one. And we'll start with probably the most important one, the income statement. We'll definitely be pulling stuff from the income statement. As we said last class,
Mr. Candy.
just a second. Everybody make sure you mute if you're not mute. See who it is, but if y'all can see who it is. Sorry. So we said last class, there's a tendency in the income statement to try to talk about above the line and below the line. Why does management like to do that? And the reason management likes to do that is something bad's happened, and they want their stockholders to think, something bad happened, but it only happens every once in a while. So when you're trying to forecast, remember, accounting is trying to help people forecast. When you're forecasting, why don't you take that bad stuff out and put it below the line? That way, when you forecast this, you won't understate your forecast. So revenues and expenses, those are the normal stuff. gains and losses. They'll do abnormal stuff so that you can forecast the company better. Let's separate those out. Now, GAAP accounting doesn't let you do that except for in extreme cases. So what management actually does is they give stockholders that information for stockholders to make the adjustments themselves. You can't do it in GAAP accounting because GAAP accounting rules are really strict. In my investment class, we talk about this. Companies have what they call reported earnings and adjusted earnings. Adjusted earnings is not a number you'll find anywhere on GAAP financials. The adjusted earnings are those earnings that have been adjusted to take these unusual things out. The stock market focuses on those adjusted earnings. Now, the one problem with this above the line, below the line is if you look historically, you would think the below the line things sometimes would be good news that's not going to repeat. So we should subtract out the good news. Sometimes it should be bad news that's not going to repeat. So we should add that back in when we're forecasting. However, well over 90% of these adjustments are losses. Management says, you know, all the good stuff, that's normal. We do that all the time. All this bad stuff hardly ever happens. Don't put that in your numbers when you're trying to forecast. So it makes you think there is some playing going on. So this is where that word quality of earnings comes up. When you do project one, I'm going to show you how I address quality of earnings. Can you trust management? But those above the line versus below the line, how much does management use those? And they can be really, really material. I don't remember the exact numbers, but pretty close. Best Buy several years ago, their reported earnings was like -$4 per share, but their adjusted earnings was +$2. So they went from -4 to +2 because they had something unusual happen. So it can be really, really material. Can you trust that? Or is management just trying to say, you know, we had a strike this year, that strike really hurt us. Because we had that strike, we had some losses. So we're going to move that below the line. And someone says, yeah, but you have a strike like every 2 or 3 years. Shouldn't that be part of your normal? Shouldn't that be part of our forecast, right? You have strikes all the time. So it's subjective. And another part of this is income smoothing. What income smoothing is, a firm's having a really, really great year, and stockholders really like nice, stable earnings. So what they do is they excessively accrue an expense. So they essentially bring next year's expenses into this year because we're having such a great year this year. We want to reduce our income so we're not so volatile. And then next year, when we discover we over accrued that expense, we overestimated, maybe it's in our warranties. We talk about warranties. Maybe put an extra 20 million in the warranties that we really don't need. And then next year, when we discover, hey, we don't need that 20 million, that 20 million gets shifted to next year, and then our income looks a lot smoother. Why? Because Wall Street really likes smooth, predictable earnings. I remember I was on the board of a credit union, and we had an accounting adjustment we needed to make, and we were given the choice of making it this year or next year. And I'm sitting there on the board, and the first question out of a board director's mouth was, what kind of year are we having? And I'm like, I don't hear that. You should not, don't do that in writing. The last thing you want to do is we're making a decision about this accounting adjustment based on income smoothing. If we're having a good year, then we'll take the expense this year. If we're not having a good year, we'll delay it the next year. That's not how accounting should be making decisions. If you're an accountant, you never want something like that in an email ever. The decision of whether you take it this year or next year should all be about what best helps those stockholders or those whoever's the investors best forecast the company. That should be your only criteria. Remember what the objective of accounting is: help these decision makers forecast future cash flows. So whether you take it this year or next year should all be based on that, not based on trying to have a nice, smooth net income. But do firms do that? Yeah, all the time. The opposite of that is the big bad theory. The big bad theory is you're in a major crisis like 2008 or COVID during 2020. You're having a horrible year. The CEO gets fired. The new CEO comes in. And what does she say? She comes in November and she says, you know, we're having such an awful year. Let's load up on it. anything bad you can find, let's put it in this year. So that next year we're going to look great and they're going to think I'm the greatest CEO ever. That's called the big bad theory. So that you only see during really bad years. Does that happen? Yeah, I've seen that before with firms. It's like, man, we're already negative, whatever. Let's accrue anything we can. Let's push it all in this year. We'll look like we really turned around next year. So income smoothing is the most common big bath. You see that in really bad years. Can you trust gap accounting? I trust gap accounting more than I did before Enron. I do think the accountants, especially the audit firms, have gotten much more careful. You've definitely seen the audit firms separating their business. You know, that's a big problem. Some of y'all are accounting majors and you're going to be making a decision whether you're going to do management accounting or public accounting. The problem the public accountants had were they were auditing firms that they're also making consulting fees from. That was the Arthur Andersen problem, right? And at USAA, Arthur Andersen is an auditor, but they also do consulting. We had, I don't know how many employees from Arthur Andersen that were working full-time at USAA. We didn't even know they were Arthur Andersen employees. So Arthur Andersen was not USAA's auditor, but it really would have been pretty awkward if they were, because you're paying them all this money a consultant, and now they're supposed to come in and give you an objective, unbiased audit, and yet you're making all this money on them. So most audit firms have done a good job of separating that out, separating the consultant, that they still do it. E&Y and all these firms still do consulting. They just, you don't want to do consulting for a firm, you're also the auditor for it. So I do think you can trust accounting now. I think it's gotten better. I think the auditors have found ways to make sure you can trust what they're doing a whole lot better. But it doesn't mean there aren't still problems. And this book right here, I'll show it to you once I can. So if you got an accounting friend and you need a good gift for them, maybe for their birthday or something, here's a book you could get them. This is also a good book for finance majors. This guy, Howard, he wrote this book. I found it to be a really, really good book. It's essentially forensic accounting. What he's trying to do is figure out if the accountants are cooking the books. And what he's telling you is, I wish I could look inside of it, but I can't find a place to look inside of it. So they're not giving me that option. If you look at the index, he goes chapter by chapter the way management commits fraud. And what he doesn't just tell you how they do it, but he tells you how you can find it. Because what he argues, if management lies on the income statement, they have to have an offsetting lie, probably on the cash flow statement. And what you'll be able to do is you may not see the error, you may not see the fraud on the income statement, but it will stick out on the cash flow statement. So that's what we are going to do. You're going to see this when we do project one. We're looking at quality earnings. I'm going to use his approach. What we're going to try to do is see if there's some big disconnect between the income statement and the cash flow statement. All right. I'm not saying it's the only thing you can do, but it's a really powerful thing to do. So I want to give you something you can use to really, really help you find very, very quickly. But if I could show you the index, he shows sometimes it's a revenue related thing where they're lying about the revenues, sometimes an expense item, sometimes it's a liability where they're hiding liabilities different ways. And he gives examples. I think that's the most entertaining part of the book. So he gives some really, really interesting examples of how managements have lied in the past. Now, he used to have a website that you could go to his website, pay him money, give him your company, and he would come back with a report with all the red flags of what he said you got an issue. That'd be pretty powerful. He sold his company out to somebody. I don't know who. So they say there's a newer version. Maybe this one would have the index. Let's see. Ah, there we go. He's got a newer version. So yeah, perfect. Just the title. Earnings manipulation shenanigan number 1, recording revenue too soon. What is recording revenue too soon? It's that you got revenue, but you haven't done everything you need to do to earn that revenue. Recording bogus revenue. He gives a really funny story about that with the firm with barbecue pits. It's kind of amazing a firm would have done that. Boosting income using one-time or unsustainable activities. Management's supposed to say is a one-time item, but they don't say that. They make their stockholders think that was a normal thing. Shifting current expenses to later periods. We talked about that with the income smoothing. So he just goes through all these different ones. Really, really good stuff. I'm not sure if accounting majors or finance majors should read this. I would say both. It would be a good book for both of you. But anyway, I do recommend it. I thought it was a very good book, very well written, very well researched, and even a little bit on the entertaining side, just because he has so many good examples there. All right, so you will talk about quality of earnings. It won't be a big part of your paper, and I have it written out for Walmart, and so you'll see how I wrote it out. So it won't be a big deal, but I want you thinking about it and knowing how you could address it. All right, so there's the income statement. We'll get an income statement in quite a bit of detail. Statement of owner's equity. As I mentioned, we're not going to use that statement at all. So we can just ignore that one. So statement of cash flows, we'll definitely be using the statement of cash flow. Very, very important statement. There's 3 pieces. So you tell me which piece this belongs in. A firm collects an accounts receivable. So I can go through cash from operations, financing activities, or investing activities. They collect on accounts receivable. Any guesses on that? What did you learn in your accounting classes? Operations. Very good, Anthony. Yeah, goes through operations. So that's something where you get a cash flow and cash from operations, but it's not part of revenue. Why? Because you sold the revenue in a previous period, but you collected accounts receivable this time. So that's something you're going to add back to your cash from operations. Your accounts receivable declined because someone paid you off. So when accounts receivable declines, that actually means you got some cash, so your cash from operations goes up. Let's say the firm goes out and borrows $40 million. What's that going to be? Operations, financing, or investing?
You said they got what?
They borrowed $40 million.
Financing?
Finance, very good. Let's say they purchase inventory and it's sitting in the warehouse.
Investing?
Operations, investing. No, not investing. What is inventory?
That's tied to operations.
Operations, yeah, very good. Operations. So what would investing be? They buy another firm. They build a new building. Those things you put in property, plant, and equipment, or you put on the book. So investing would be those. We're going to use the term CapEx. You'll see that in paper 1, CapEx, capital expenditures. What we mean by capital expenditures, it's an expense, but we're not going to treat it as an expense. We're instead going to set it up as an asset and put it on the book. So you buy a building, you buy a truck, those kind of things. We're going to put it as an asset. It's going to go through investing activities. It's going to be part of our CapEx. Now repairs, Dante, it just depends. It all comes back to what accounting says. If you have an expenditure that has an advantage for several years, that can be a capital expenditure. So if Walmart goes in and I don't know, refurbishes a building, remodels a building, and it costs them millions of dollars, yeah, they're going to capitalize that and make that part of their building costs, and that would be a capital expenditure. If they go in and fix a few floor tiles, something material, they're probably just expense that. So it's, it's not always obvious, but what accounting says, hey, if you're spending money that's going to have future years advantages, you should capitalize that, put it as an asset, and depreciate it over the life of that asset. But accounting doesn't always do that. Even though if Walmart goes out and buys $1,000 of paper clips, it's true, they'll probably still have those paper clips 20 years from now, but guess what they're going to do with that? They're just saying and expense it as an office supply, right? We don't get ridiculous. Paper clips, $20. We're going to depreciate over the next 50 years. Who knows? I don't know how long a paper clip lasts, but We don't get ridiculous. So it's not a precision perfect kind of thing, but definitely CapEx is an extremely important concept in understanding the business. You're going to see this. You actually have a chart on CapEx. You'll see next week when we get into it. It's really important. You want to know, is the firm increasing its CapEx or is it reducing its CapEx? You're going to see a lot of firms here recently have actually been reducing their CapEx. They've been paying a lot of dividends, buying a lot of stock back. And a big part of that might be they're just not reinvesting as much in the firm as they used to. All right. Now, there is one, if you look at the notes, you'll see it. If I pay dividends, that's a financing activity. Everybody agree with that? If I pay my stockholders dividends, that's financing. If I repay my debt, that's financing. All right. If I borrow money, that's a financing activity. If I repay the debt, that's financing. If I buy stock back, that's financing. If I issue new equity, new stock, that's financing. What if I pay interest on my debt? What is that?
That's
If I pay dividends to
financing.
stockholders, say it again.
Wouldn't that be financing?
It should be. Does that sound like Dante? Was that you, Dante?
Yeah.
Yeah, I remember your voice from your great class from last semester. It should be financing. I absolutely agree with you, Dante. Unfortunately, the accountants put it under operations. What I don't understand is why GAAP accounting hasn't fixed that. When I took my CFA exam, the first part of the CFA exam, and it's an exam for investment professionals. The first exam has a heavy accounting part to it. And I thought, I'm a CPA, I'm going to ace this part of the exam. Unfortunately, the exam wasn't CPA stuff. The exam was take GAAP accounting and fix it. And I thought, oh, great. So that I had to think through that. One of the things they say to fix is take interest expense and add it back to cash from operations and take it out of financing activities. It's really hard to do because it's hard to find that actual line for interest expense. So interest expense should be a financing activity. Unfortunately, GAAP accounting has it as cash from operations. So it is an issue that messes things up. And one of these days, GAAP will fix that because remember, GAAP is for investors and creditors. Investors and creditors are saying, don't put interest expense under operations, put it under financing. But the accountants, for some reason, have refused to make that change. All right, there's two types of cash flow statements, but you're almost all going to see the indirect method. I don't know anyone that does the direct method. The indirect method is that you start with net income, you add back and subtract non-cash items. All right, so we're going to get into that. We'll look into that some. But like I mentioned, you start with net income. If your accounts receivable came down, that means you collected your accounts receivable. You're actually going to, when accounts receivable reduces, you're actually going to add that back to net income to get the cash from operations. If your inventory increases, you must have bought more inventory, but you haven't sold it yet. So then it didn't count as cost of goods sold on your income statement because you haven't sold it yet, but you did pay for the inventory. So if inventory increases, you're going to subtract that increase from cash from operations. All right, so we'll get into that a little bit. So there are some parts of the direct method which I think are really quite powerful that we'll talk a little bit about. So the question is, which is better, GAAP net income or cash from operations? And the answer is yes. They both have their purposes. They all have their role. One is better in one case, one is in the other. Wall Street really focuses on the net income side of it. But when they're doing their analysis, they do use the cash from operations quite a bit. And CapEx is really important under the investment side. So they both provide really important information.
I have a question. Isn't cash from operations just the net income without the accounts receivable?
Well, let's talk about it then. What could be in there? So, I mean, that's a great question. So you got net income. We're talking about, y'all know what CFO is, cash from operations. So net income, So we're gonna add back what? Well, I agree with you. We're gonna add back a decrease in accounts receivable. Or subtract an increase in accounts receivable. So if you're finance or accounting, you really need to understand this. If you're not one of those two, you probably should still understand it just because you want to be strong in everything, even if you're a cybersecurity. Why do we add a decrease? So if accounts receivable went from 50 million to 40 million, we're going to take net income and add 10 million back because our accounts receivable dropped 10 million. Why do we do that? Well, at the end of last year, people owed us $50 million. At the end of this year, they only owe us $40 million. They must have paid us $10 million. But that's not on our net income. Why? Because our net income showed that in the year the accounts receivable was set up. So a reduction in accounts receivable is added back to net income. The exact same thing is true. So you talked about accounts receivable. What else would we have? The exact same thing is true for inventories. If inventories went down, we must have sold some inventories that we bought last year. We must have sold them this year. And that went through as an expense on the income statement as a cost of goods sold. But we actually bought that inventory last year. So we didn't have a cash flow, right? Cash flow was last year. So if inventories came down, we must have sold some inventory we bought the year before. So we're going to add that back to cash. If our inventories increase, we must have inventories that we purchased this year that we haven't sold yet. So it hasn't gone through cost of goods sold. So there's a cash flow that's not in our income statement. So we need to subtract it out. What else is there? We're going to add back an increase in accounts payable and subtract a decrease in accounts payable. So if accounts payable goes up, we owe our vendors more money. That probably was shown as an expense on our income statement, but we haven't paid our vendors yet. So last year we owed them 40 million. This year we owe them 50 million. All that goes through as an expense on our income statement. We haven't paid them yet. There's $10 million we didn't pay them, so we need to add that 10 million back. Or if accounts payable decreases, so we owe them $50 million last year, and now we only owe them 40 million, we must have paid off $10 million of that payable. That didn't get reflected in net income, but it was a cash flow. We need to subtract it, all right? This is real tough for a lot of students, especially if you're not an accounting major. If you're an accounting major and this is really tough, I would spend some time really getting to know this. Hopefully you'll have a really good accounting professor that will show you how to do this. But when current assets increase, we're going to subtract that out of net income to get the CFO. When current liabilities increase, we're going to add that back to net income to get the CFO. All right, so there's three things. What else is there? There's other items, and there's many other items. I don't want to get into all of those. Capital gains is one. What does that mean? That one's a really complicated one. I don't know if I want to get into that or not, but just real quickly, you don't need to know this for the class. But let's say a firm sold an asset and they sold it for a big gain. So let's say they sold it for $100 million. It was on their books for 80 million, so it had a $20 million gain. Well, their net income is showing this $20 million gain, but they sold the asset for 100 million. Well, that 100 million actually goes through investing activities. So you had $100 million in cash, and you're going to put that as an investing activity, but then net income is showing a $20 million gain. So now you got $120 million, but you only had $100 million in cash. And so what accounting does is they say, okay, you have $100 million that you sold the asset. That's an investing activity. You got $20 million in net income for the gain, but that's not a cash flow. So any capital gains, we're going to subtract that from net income to get the cash from operations. That's a pretty complicated thing, right? Other things, it's just maybe you have a pension funding. You fund your pension plan, that's going to reduce your CFO. So there's a lot of things. So we're going to see this when you get on the first part. That's why the first part of this paper is so difficult, that you're going to look at your company and you think you got it figured out. But when you look at cash from operations, you discover, boy, this isn't consistent. I'm not seeing, the numbers don't make sense. And that's probably because your firm has some major other item that's going on. Maybe I'll find one or two of those where I can show you how you can actually go to the financial statements of the firm and figure out what those other things are. There's one person that was doing an analysis on this, and when she looked at all of those current assets and current liabilities, she said, wow, their CFOs should have been going up, but it actually went down. And we looked into the books and discovered the firm had a really large pension funding that year. And they go, okay, I see why there's a disconnect there. All right. Do your best to try to understand that, but it's tough. You don't need it so much in this class because it's not an accounting class, but it sure helps in your understanding of finance to have a good understanding of how the balance sheet, income statement, and cash flow statement all link together. It's one of the toughest parts for a lot of students. And in fact, on the CFA exam, part 1, they actually will do problems where they'll make you reconcile the balance sheet, income statement, and cash flow statement and be able to work those all three together. All right, I don't know if that answered the question, but kind of the answer is it's complicated. The key for finance is a term that's nowhere on the financial statements. It's a term, if you're a finance major, you will hear a lot, but your other majors will not. But finance, this is a really important term. If you're interviewing with an investment bank, you'll really need to know this term. We call it free cash flow. So free cash flow does not equal cash from operations, but is related, right? So it's not the same thing. Boy, I wish I could type. This new keyboard of mine like ignores half of my keystrokes for some reason. So free cash flow is not the same thing as cash from operations. They're probably related. If your cash from operations jumped, there's a good chance your free cash flow jumped, but they're not the same thing. If you take other finance classes, they'll actually give you a formula for free cash flow. I don't believe those formulas. I don't think you can actually calculate free cash flow that easily. In fact, I think it's quite complex. It's an extremely important number, but it's somewhat subjective. Some of y'all might have a Bloomberg account and you're using Bloomberg. Bloomberg will give you the free cash flow of a firm, but you're entirely dependent on their definition of free cash flow. It's a subjective, difficult number. So what is free cash flow? There's a book I really, really love that I highly recommend. It's this book here. I recommend it mainly to finance majors. It's called Free Cash Flow Yield. It's by William Priest. You can find it out there, or Shareholder Yield, excuse me. And what he says, and I really like what he says. In fact, I like this book so much. My last year at USAA, I did a trip up to New York to visit all of our vendors, and I visited William Priest's firm, even though we didn't have any business with him, and brought the book. I just wanted him to sign my book. And he wasn't there that day, so I had to sit and listen to a stupid presentation. All I wanted was his signature. But he's a really good writer. It's a really good book. It's a short book, and it's pretty easy to understand. So what he said is free cash flow is a hard number to calculate, but we know it when we see it. And what he said is, what is free cash flow? Free cash flow is when the firm produces cash flow that they have options with. If a firm is producing free cash flow, they can pay dividends to their stockholders. If they're producing free cash flow, they can buy their stock back. If they're producing free cash flow, most firms don't repay their debt. They just keep rolling it forward. So if they have $100 million of debt coming due tomorrow, They just borrow $100 million to pay off that $100 million. But if a firm has free cash flow, they can actually pay down that debt. They might do what Apple's doing and Microsoft is they're producing so much cash and they don't know what to do with it. So they just let it sit in cash. You look at Apple that's had like $200 billion in cash, and Microsoft that's had over $100 billion in cash. Their firm is producing a lot of free cash flow. They just can't figure out what to do with it. And the last one is the tough one. So these first four are really very, very easy. The last one's a tough one. The last thing you can do with the free cash flow is you can reinvest in the firm to expand capacity. What is not a free cash flow is when management reinvest in the firm just to keep the firm right where it is. So if Walmart's spending money to fix its buildings, that's not a free cash flow. They have to spend that. But if Walmart builds a new building, builds a new store, they didn't have to do that, right? They could have just sent that money back to their stockholders. They didn't have to build a new retail outlet. Seems to me they got plenty of them as it is. I can drive to two Walmarts. They're like within 2 minutes of each other in my neighborhood. Like, do we really need a Walmart right there and right there? They're all over the place. Walmart doesn't necessarily need to build another building. That's management's decision. So management says, hey, we can pay its dividend, we can buy stock back, we can pay down our debt, or we can build a new store. That is a free cash flow. That's the key. The free cash flow is management has options. Free cash flow does not mean it doesn't cost anything. Management needs to get a good return on anything they do with free cash flow. So if they're going to do expansion, they better make sure they're getting a good return on it. What free means is freedom to do something with it. They have options. A non-free cash flow, the part of cash from operations that's not free, whose management has no choice, but they have to do that just to maintain where they are. So the key is how much of CapEx, remember CapEx is under cash for investing activities. How much of CapEx is expanding expenditures, making the firm bigger, more markets, more stores, and how much of CapEx is just maintenance, keeping you where they are. Now, if you want to figure that out, it's not easy, but I do have a blog. And some of you want to try that. I have a blog where I go through how you can do that with a Walmart. I do regression. And essentially what I do is I say, let me look at their cash from operations and let me look at their how many square feet they have and their CapEx. And what I try to figure out is how does CapEx change as Walmart adds more square feet? Because you'd agree with me, right? If Walmart square feet went from 20 million square feet to 22 million square feet, they must have expanded the firm to 2 million square feet. They must have had some CapEx that was expanding. And so that's what I did. I said, okay, let me look at CFO, let me look at investing CapEx, and let me look at the number of square feet. Let me run a regression. What I'm trying to figure out is what would CapEx be if Walmart added no new square feet? So if they don't add any square feet, that CapEx must be maintenance CapEx. That's what I do. It's a regression analysis. It works pretty well for Walmart. Would work really, really well for restaurants. Doesn't work really well for Google. I don't know what you would do for Google or Alphabet or for Meta or Facebook. So if you're a finance major, I do recommend you read that blog. It's got some good stuff in it. Dr. Katapakam, who's a professor, you're a finance major, you definitely want to take his corporate finance class. He talks a lot about free cash flow. He actually read my blog and fixed one of my mistakes, which was kind of nice. But he didn't disagree with it, so that makes me feel good because he's UTSA's guru on free cash flow. But that's what William Priest is saying, is the firms he wants to invest in are those firms that are increasing their dividends, are they're buying their stock back, are they repaying debt, you're seeing a growth in their short-term investments, are they doing expanding type capacity. And it needs to be a combination of this. Some of your firms, y'all be ready for this because this is a tricky thing. Some of your firms are buying their stock back, but they're doing it by issuing debt, not by repaying debt. If a firm is borrowing $100 million so that they can buy back $100 million in stocks, that's not a free cash flow, is it? If they produced a free cash flow, what would they have done? They would have bought the stock back, but they wouldn't have to issue any debt. So if the company's generating a lot of cash, they'll just buy their stock back. They don't have to go out and borrow money to do that. So what are you going to do if your firm is borrowing money in order to buy stock back? You can say, wow, they're buying the stock back, which is great, but that's not evidence of free cash flow because they're having to borrow money to do it. They don't have the cash to buy the stock back. So they're actually going out and borrowing money to do that. You will have a chart in your project one that's covering that very issue. All right. Any questions up to there? Man, we've covered some. I can tell from y'all's face, the ones that are on video, y'all look kind of concerned. Very few of you are on video, so I don't know why that is, but okay. Y'all must have questions or you're so catatonic you can't possibly ask a question because it's just too much. This is like the fire hydrant. I will say I haven't covered anything you didn't have in your accounting class. So the question is, how much did you remember from your accounting class? So hopefully you remember some of this stuff. All right, fortunately for you, if you're not sure about it, you're going to see when we get into the project that we're going to rehash the more difficult parts of this. So what we're going to do next week, when you have your company in front of you, is we're going to do financial statement analysis. Extremely important stuff. We're going to write a paper. I'm going to give you the template. It's a paper that we finished it, even though everybody's using the same template. It's a paper you can definitely put on LinkedIn. It's an impressive looking paper, very detailed. So you're essentially editing what I did for Walmart, but you're going to do it for your own company. You might feel like you're plagiarizing, but you're going to have to edit it quite significantly for your company. So let me introduce this, and next class we'll do it. So financial statement analysis can also be known as ratio analysis. We're trying to assess the firm's position and its performance. And we might do that across time. That's called trend analysis. We might compare it to peers and its industry. That's how I set it up for you. We're going to compare it to its industry. And I'll show you how I like to do that. It's something I recommend that you do. It allows you to compare firms of different sizes. So we can compare Walmart to Dollar General. Walmart's a much bigger company than Dollar General. But if we do ratios, we can compare the two companies. And then rules of thumb. I'm going to show you how I do rules of thumb. Rules of thumb are really difficult because every industry has their own. I remember I got a document from Standard & Poor's where they listed all the rules of thumb for every industry, and that thing was a thick, thick, thick document. So every industry, my industries are insurance and banking. I know those industries really, really well. I could give you dozens and dozens of ratios that are specific just to those industries because that's my area of expertise. But every industry has their own thing. So I'm going to show you how I have a little trick. I'm going to show you how to come up with a real quick rule of thumb. So make it kind of easy. One thing we have to be careful with ratios is we're dividing by something on most ratios. So if we do a turnover ratio, we take revenue divided by assets, we're dividing. Anytime you're dividing one number into another number, you have to be really careful if one of the numbers is negative, especially if the denominator is negative. That's an issue. I'm going to show you how to handle that. Dante, if you decide to use Netflix, I'm going to show you how you can handle Netflix negative CFO. There's some tricks we can do. So I'm going to show you some tricks. I might even show Netflix as my example. The other issue you have is sometimes firms have a number. Let's say their cash from operations is normally $2 billion, $2.2 billion. And then something strange happens and their cash from operations is only $10 million. Well, if you divide by $10 million when you've been dividing by 2 billion, you're going to see it. Your graph is just going to shoot off the page because you're dividing by such a low number. So we'll have to look at that. So I'm going to show you how to handle that. I got some tricks I'm going to show you. Sometimes if you're dividing by 0, the model's going to give you NMF, which means not a meaningful figure. So I'm going to use an if function. It says if my denominator is 0, give me an NMF. That doesn't mean there's a problem with your company. All right. So I'll show you, just because you have an NMF doesn't mean there's something wrong. It just means we can't do that. One thing we're going to use in our class is a CAGR. Down here you see a CAGR, a compound annual growth rate. A compound annual growth rate is giving you the annual growth rate in a number. So if you want to know what the annual growth in revenues is, we're going to calculate the CAGR. CAGRs are wonderful. The only problem is with a CAGR, you cannot calculate a CAGR if the sign changes. If you started with a negative $20 million and went to a positive $40 million, you won't have a CAGR. It's going to give you an NMF. If you started with a positive 40 million with a negative 20, you're going to get an NMF. So I'll show you that. Doesn't mean you got to pick another company or it's not working. I'll show you how to handle that. All right. So there's some tricks there. So all of those, we're going to see all of those. So we're going to start here next time. And here's the model we're going to use. This is not Professor Sweet's model. This is a very standard model out there. All right. I'm not giving you something out there in left field and then you get in your first interview and you're like, what are you talking about? This is very normal stuff. If you get your first job in finance or accounting and they tell you to do a financial analysis, which is pretty common, just do this. All right. And you'll be fine. They'll be impressed actually. So just do this and you'll be in great shape. So we'll start there. So any questions on anything